Welcome back, focus learners. Let's jump right into this explainer. Today, we're unpacking something absolutely fascinating: the exact mechanisms of how the ultra wealthy use debt, yes, actual debt, not as a burden, but as their primary tool to legally avoid taxes and exponentially multiply their wealth. It is a complete 180-degree flip on how most of us are taught to view personal finance, and understanding it gives you a crystal clear picture of how wealth is actually built and maintained at the very highest levels. Okay, let's dive into this. From a young age, we're practically hardwired to think debt is dangerous, right? We're told it's a trap to be avoided at all costs. And honestly, for about 95% of folks out there, that advice is absolutely true. Bad debt can, for sure, ruin you financially. But switch over to the top 1%, and we see a completely contrasting approach. To the ultra-wealthy, debt isn't a trap at all. It's actually their single greatest tool for legal tax avoidance and rapid wealth expansion. While the average person works incredibly hard just to slowly chip away at their loans, billionaires are out there actively doing the exact opposite, taking out millions of dollars in new debt to get richer. Which brings us to Section 1, the two financial playbooks. We're really looking at two totally different rulebooks here, depending entirely on the strategy you use. On one side, you have the average taxpayer. They earn a great salary, maybe take home some nice bonuses, but they face a really steep tax rate, often right around 37%. They're paying heavily into the system on the money they earn from their daily labor. But then, look at the billionaire framework. By leveraging debt instead of drawing a traditional taxable income, their effective tax rate on that cash flow drops all the way down to 0%. They are legally bypassing income tax using a very specific, somewhat hidden loophole in the system. Let's move on to Section 2, the income tax trap. To really wrap our heads around how this is 100% legal, we have to look at the underlying mechanics of how the government collects its revenue. The fundamental rule to remember here is that the government heavily taxes income, money you make directly from your labor. Earn a massive year-end bonus, and Uncle Sam can easily take up to 40% of that money before it ever even hits your checking account. However, what the government does not tax is unrealized wealth. We usually call these paper gains. If your investments grow in value but you don't actually sell them, you haven't realized the gain, and therefore the government does not tax it. Let's walk through a specific example so you can really see this in action. Imagine a billionaire owns $100 million in company stock. It's been a stellar year for the market, and bam, that stock shoots up in value to $150 million. What they've just done is create $50 million in paper wealth. Their net worth just absolutely skyrocketed by $50 million bucks. And this brilliantly illustrates the core of the whole strategy. Think about it. How much tax do they owe on that massive $50 million gain? Exactly $0. As long as they don't hit the sell button, that stock isn't considered income, so it literally cannot be taxed. It just sits right there, completely untouched by the tax code, steadily growing their net worth. But you're probably seeing the logical hurdle here, right? Paper wealth looks fantastic on a spreadsheet, but a spreadsheet can't buy a mansion. It can't buy a private jet or fund a lavish lifestyle, or even be used to buy more investments. You need liquid cash for all of that. So if selling the stock triggers a massive tax bill, how in the world do they actually spend this wealth? Well, that brings us to Section 3, buy, borrow, die. The answer to that liquidity problem is a highly sophisticated three-step framework that financial insiders quite literally call buy, borrow, die. This is the exact playbook used to pull cash out of assets without ever triggering a taxable event. Let's break down these three exact steps. Step 1 is buy. The wealthy buy appreciating assets, things like stocks, real estate, or entire businesses, assets that grow over time. Step 2 is borrow. Instead of selling those assets for cash when they need money, they simply go to a bank and borrow against them. They use their multi-million-dollar portfolio as collateral for a massive loan. And finally, step 3 is die, where the wealth passes down cleanly to the next generation. The real magic happens right there in step 2, the borrowing. Let's say our billionaire takes out a $5 million loan against their stock portfolio. The bank just hands them $5 million in liquid cash. But here is the absolute genius of the tax code. Borrowed money is not considered income. Because it's a loan that technically has to be paid back, the IRS doesn't tax it. They get millions in cash, pay exactly 0% in income tax on it, and then use that incredibly cheap money to fund their lifestyles or just go out and buy even more assets. Now, you're probably asking the obvious follow-up question here. A loan is a loan, right? Don't they eventually have to pay the bank back with interest? Yes, they absolutely do. Which leads us perfectly into Section 4, the compounding wealth loop. Now, what's really interesting about this slide is the sheer power of the math involved. The way they handle that debt actually creates a compounding wealth loop. Yes, there is interest on the loan, but the math leans heavily, entirely in the borrower's favor. If their massive asset portfolio is growing at an average historical rate of, say, 8 to 10% a year, and the bank, knowing this loan is super safe because it's backed by huge collateral, is only charging them 4% interest, they're still making a massive net profit. The growth outpaces the cost of borrowing by an incredibly wide margin. So how is that debt actually managed day to day? Well, there are a couple of ways. Because they're netting that positive difference, they can just peel off a tiny fraction of the asset growth to slowly pay down the loan interest over time. Or, and this is very common, as their asset values just continue to skyrocket year after year, they simply go back to the bank, increase their line of credit, and take out a brand new, bigger loan to pay off the old one. The appreciating assets essentially pay for their own leverage indefinitely. Which brings us to the final, somewhat morbid step of the strategy: die. What happens to all this accumulated debt and unrealized gain when the billionaire passes away? This is where a very specific, extremely powerful tax rule called the stepped-up basis comes into play. When heirs receive these assets, the tax value of the assets is stepped up to whatever the current market value is on that day. This means all of those old accumulated capital gains taxes from decades of growth, they just disappear completely. Poof! The assets can then be sold tax-free to pay off the outstanding bank loans, the loop is completely closed, and the remaining massive wealth stays safely and legally within the family. It is an incredibly powerful, self-sustaining cycle. Let's bring it all together in Section 5, the Financial Matrix Lesson. Let's bring this explainer home. The most absolutely crucial takeaway for you, the focused learner, is that you do not need billions of dollars to apply the core logic of this lesson to your own life. Just look at the comparison here. The old way of thinking focuses almost entirely on earning a high taxable salary, grinding harder to get a bigger paycheck that just gets taxed at a higher rate. The wealth framework, however, shifts that focus heavily. It's all about acquiring assets. It's about owning things that grow in value, things that you can eventually leverage. So the ultimate macro takeaway from this entire explainer is exactly this. You have to shift your strategy from just chasing a paycheck to building a portfolio. Whether we're talking about stocks, real estates, or a small business, acquiring assets that appreciate and can be leveraged down the line, that is fundamentally how the financial game is truly won over the long term. You want to build a leverageable portfolio that works for you rather than you exclusively working for a highly taxed wage. Understanding how the system is actually wired is the very first step to successfully navigating it. So I'll leave you with this provocative question to chew on. Are you ready to master the rules of the financial matrix? If you found this breakdown valuable and want to keep learning how to build and leverage your own portfolio, make sure to subscribe to the channel. Keep building your knowledge base, and I will be right here waiting to see you in our next explainer.